Hello and welcome to my YouTube channel. I'm Safir Ahmed, a senior lecturer in accounting and finance at a UK university. I also work with ACCA as an early career investor. This video is going to be relevant for ACCA F3 and F7 students, AAT Level 4 drafting and interpreting financial statement students, and if you're studying CIMA BA3, which is financial accounting, or if you're studying international accounting standards and international financial reporting standards as part of your module or unit, it could be university undergraduate degree or postgraduate degree. So in this video, I'm covering 3 key international accounting standards. So the first one is IAS 37, which is provisions, contingent assets, and contingent liabilities. The second one is IFRS 16, which deals with leases. And then IAS 36, which is impairment of assets. So what I'm going to do is I'm just going to talk through the summaries of each of these standards. And once I've done that, I will go over one of the AAT Level 4 practice assessment for drafting and interpreting financial statements. Now, IAS 37. This standard is quite important for practical reasons as well as for exam point of view. Now, if you think about it, provision is a liability of uncertain timing or amount. So at the time when we are making provision, we are not 100% sure how much amount we will have to pay in relation to a provision, or the timing, the when exactly we will be paying it. So you can see the importance of it because estimation is involved. Now, normally, when you are recording, for example, sales revenue, we know we earned it. Or if we are recording asset, we know we have spent that much money and it's definitely over asset. But when it comes to the estimates are not based on facts fully because we don't know exact amount or we don't know exact timing when exactly we will be paying a certain amount. So the way the question comes from provisions is you will be given a court case and you need to decide whether you need to make a provision or is it a contingent liability. So we will be looking into that. When we have to make a provision, there's a certain criteria that it has to be met if we want to record a provision. Now, first of all, just a double entry for provision. So double entry provision goes into your statement of profit and loss or statement of comprehensive income, in other words, as an expense. And then credit, again, provision. Credit, again, provision. And this goes into your statement of financial position as a liability. To be more precise, this statement of comprehensive income, we normally include as part of the admin expenses. And then provision, this could be part of the trade and other payables under current liabilities. Okay, so provision is a liability of uncertain timing or amount. Now, there must be, when we can create a provision or when we have to provide for certain expense, there must be an obligation. So this obligation can be legal or constructive. Now, the legal obligation is the obligation which is imposed by law, which is maybe a written agreement. It could be a contract between two parties. So this is required by law. So it could be the outcome of the court case, for example. For example, if a customer sued a company, and then the company is going to provide for that court case, just as an example. So it has to be either legal obligation or constructive obligation. So legal obligation is straightforward because that is required by law. Constructive obligation. Now, there is no legislation about that obligation, but it is through past practices or valid expectations. So, for example, refund policy in case of faulty goods, that's not the law, by the way. But if the company has a policy about it, and in the past that they have refunded to the customers, so in that case, of course, there is a constructive obligation that the organization, the company has created through the past practices, of course, for the better customer service or, after sales services. But this is created by, so constructive obligation is not imposed by law, but it has been created by the organization itself, by the company itself. Okay. So there must have to be a legal or constructive obligation. That's the first criteria for a company to provide a provision or to make a provision in the financial statements. The second one is probable outflow of economic benefit. So probable, what do we mean by probable? That the chances of happening is more than 50%. So in other words, in case of a court case, that the chances of paying these damages, whatever the customer has claimed or maybe employee has claimed, so if the chances of happening is more than 50%, it is probable. So it has to be probable. Now, if the chances of happening is less than 50%, it is possible but not probable. So the second criteria in order to make a provision is that it has to be probable outflow of economic benefit. The third one, which is a reliable estimate, can be made. So near to actual figures. So maybe based on some guidance from solicitors, for example, in terms of the court cases, or it could be an estimate based on past cases, similar cases like that. Yeah. So if one of these criteria will be missing, the company cannot provide or does not need to provide as well. In other words, they don't need to create a provision. And remember, the provision goes into on the face of the financial statements, like I just talked about that here. What will be debit, what will be credit. So one in credit provision, statement of financial position, and debit provision, which is part of the statement of comprehensive income or statement of profit and loss. So that's all about provision. Now, contingent liability. Now, contingent liability is a possible obligation. It's a possible liability which will be confirmed in future. Okay. So a possible obligation that will be confirmed in future. This is the shortest sort of definition, but the proper definition as per IAS 37 is a possible liability, the occurrence of which will be confirmed by the occurrence or non-occurrence of a future event. Okay, but this is the shortest sort of definition which covers the main point. So possible obligation that will be confirmed in future. So maybe something in case of a court case, for example. So it depends on the decision of the judge or the court. Yeah. Now, contingent liability is not a liability. Remember that the definition of a liability is a present obligation, but this is kind of a future of possible obligation. So therefore, it does not meet the normal definition of liability. Therefore, we can never write contingent liability in our financial statements. So if it will be probable, then it will be a provision. If it is possible, those court cases, if those are possible, meaning that maybe there are chances of losing the case is 30% or anything less than 50%, basically. So what we do in terms of the contingent liabilities, if it is material matter, we disclose it in the notes to the financial statements. If it is remote then happening, then we don't do anything. And what do we mean by that is we are not going to record it anywhere. So we are not even going to record it under notes to the financial statements as well. So what you need to remember in terms of the contingent liability, if it is material, okay, and if it is material, we will record it in the notes to the financial statements. And of course, it will be a possible obligation. If it will be probable, perhaps it will be provision, and then you need to look at those criteria. And if it is remote, then happening, maybe the chances of losing the case for the company is 5%. Then, of course, it's remote then happening. So then you want record it anywhere. Contingent assets. So again, possible assets, existence will be confirmed from future event. Now, the definition of an asset is a resource controlled by the company. If you think about a possible asset is not controlled by the company, and therefore, as it does not meet the definition of an asset, we can never write it in the financial statements or on the face of the financial statement. So what we can do about that is, if it is probable, then we disclose it in the notes to the financial statements. So probable means, of course, the chances of happening is more than 50%. If it is possible, just possible, then we don't really write it anywhere in the financial statements. So there's a difference between contingent liabilities and contingent assets. Contingent asset, it has to be, it is a possible asset, but it has to be probable to disclose it in the notes to the financial statements. And if it is remote, or also if it is just remote and the chances of happening is less than 50%, in other words, which is just possible that we might have a contingent asset, in that case, then we don't do anything, we don't record it in anywhere. Also, if this contingent asset becomes virtually certain, so for example, we received the court decision that the company won 30,000 damages in something that they have sued a third party. So in that case, now it is not contingent anymore. So in that case, you can record it as a normal asset. Yeah. But it has to be virtually certain in order to do that. Okay, so this is a summary of the IAS 37 provision, contingent assets, and contingent liabilities. As you know, each international accounting standard has normally detailed knowledge. But if you're studying F3 financial accounting in ACCA or BA3 in CIMA or level 4 drafting and interpreting financial statements, this is normally sufficient. But if you are studying F7 financial reporting, please make sure that you are familiar with every point of that standard. Okay, the second international accounting standard, which is a recent one, IFRS 16 leases. Now, if I give you a little bit background about this standard, you will understand it better. So we used to have International Accounting Standard 17 leases, and this came into effect, IFRS 16 leases, on 1st of January 2019. So before 1st of January 2019, we used to have IAS 17. And what used to happen, that IAS 17, in accordance with that, we were dividing the leases into operating leases, and finance leases. And what we used to do is operating leases, we were just recording it in the statement of comprehensive income as an expense. So annual lease payments. Finance leases, what we used to do, we used to record it as an asset and the corresponding liabilities and the finance cost. And we used to depreciate it as well. Now, there was a problem with that because companies could choose operating leases if they don't want to show these liabilities. So in other words, that this was one of the off the balance sheet finance at that point. So therefore, International Accounting Standard Board came up with a solution, which is IFRS 16 leases. So since then, majority of the leases are considered as finance leases. In other words, we don't use the word finance lease, but majority of the leases will be, what we'll be doing, we'll be recording it as an asset, liabilities, finance costs, and depreciation. So the companies cannot really take them off the balance sheet. Having said that, there are some exceptions, and I will talk about that in a minute. Now, so this is a summary of the accounting treatment for IFRS 16 for majority of the leases. So the company will record a right to use asset in statement of financial position, depreciation as part of normally admin expenses in the statement of comprehensive income, and finance cost, which is statement of comprehensive income as well, and short-term lease liabilities, so due within 1 year in relation to this lease, and long-term lease liabilities due after 1 year, so which goes into your statement of financial position. So this is a full summary of the accounting treatment in relation to the leases from the lessee's perspective. Because remember that there is a company which is the one which is leasing it from another company is the lessee, and the company which is finance companies, those companies are lessor. So here I'm just talking about from the lessee's perspective, not the lessor's perspective, okay? So there are a couple of exceptions to that rule. So one of the exception is that low value leases can be expensed out in a statement of comprehensive income, and similarly short-term leases can be expensed out in a statement of comprehensive income. Now this standard has been criticized by the financial analyst due to the fact that there are still some exceptions, and then companies can utilize that loophole in the system. So these leases exceptions, these can be expensed out in your statement of comprehensive income. Now, and it's a little vague as well. Okay, what will be considered as a low value lease? The standard doesn't really tell us. So the companies can say, well, maybe £20,000 we consider as low value lease in relation to their revenue, especially large companies, if that makes sense. So there's still loophole in the system, if that makes sense. Similarly, short-term leases, they said anything up to 12 months. Again, if a company does not want to show these leases in their financial statements, they might make that arrangement contract with the lessor in such a way that it is renewable every year. So that's why you can see the problem there. Okay, so that's about leases. So let's move on to the next one, which is IAS 36, which is impairment of assets. So it is based on the prudence concept. Now, what is prudence concept? That companies got to be careful they do not overstate assets and profit. In other words, revenues as well. So they do not overstate revenues and assets, and they do not understate liabilities and incomes. Liabilities and expenses. So that's the prudence concept. Remember that companies tend to do that. So what prudence concept is, make sure you don't do that. You don't overstate your profits, in other words. So do not overstate assets and incomes, revenues, and do not understate expenses and liabilities. So therefore, if an asset is impaired, we need to record it, or we need to deduct the impairment from the asset's value in our statement of financial position. So impairment loss is amount by which carrying amount of an asset exceeds its recoverable amount. Now remember, what is carrying amount? Carrying amount is, if I remind you, remember, is cost of the asset minus accumulated depreciation. So depreciation to date. Accumulated depreciation, which is amalgamated depreciation or combined depreciation of all previous years until now. And then recoverable amount, the standard tells us the recoverable amount will be higher of the value of the use, higher of the value of the use or value in use if the company will continue using this asset, and is fair value less cost to sell. Now, what is a fair value? Fair value is, in other words, you can fairly say market value. So fair value is the an arm's length transaction, which is, in other words, on commercial basis. So with knowledgeable willing parties. Yeah. An arm's length transaction, in other words. Yeah. So recoverable amount, it is the higher of fair value less cost to sell and value in use. Okay. So if the carrying amount is greater than the recoverable amount, that means that impairment loss happened. So impairment loss, in other words, we can fairly say it is the amount by which the carrying amount exceed its recoverable amount. So if we want to write that in an equation, I can just write it here. So impairment loss will be equal to carrying amount. Now remember, another name of carrying amount is net book value. So in some qualifications, they use the word net book value rather than carrying amount. So carrying amount minus recoverable amount. And if the carrying amount will be greater than the recoverable amount, then the impairment, the asset has been impaired. Okay. So as you can see, the fair value is the price that would be received to sell an asset or paid to transfer liability in an orderly transaction between market participants. So in other words, it's an arm's length transaction. It's on commercial basis. And value in use is the present value of the future cash flows if the company will continue using this asset in future. So higher of those two. Okay. IAS 36 applies to non-current asset. It does not really apply to current assets. So please be mindful about that. They can trick you. They might give you a situation in relation to IAS 2, which deals with inventories. And remember, inventories is a current asset. So IAS 36 impairment of asset is not really applicable for current assets. Okay, so certain assets that have to be tested for impairment, an intangible asset with an indefinite useful life. Why is that? Because if you think about intangible asset that we don't amortize if it has indefinite useful life. So therefore, the chances are that we might be overstating it. So therefore, the company must have to check the impairment every year. Or similarly, if an intangible asset not yet available for use, so we have not really amortized it, they should be checked that if they have, if that such asset has been impaired or not. Similarly, goodwill acquired in a business combination. In my other video, if you remember the consolidated statement of financial position video, I talked about goodwill, how we calculated goodwill. Now, goodwill normally have indefinite useful life, therefore, that we don't amortize goodwill. So what we have to do, we must have to check impairment of goodwill every year. Okay, now, so these assets must be checked for impairment on annual basis normally. Apart from that, we will only check impairment of an asset if there is an internal indication or external indication of it. So external sources of indication, a significant fall in assets value, adverse effect on entity caused by technology, market, or if there is a change in legislation or increase in interest rates or negative goodwill about the business, maybe reputation of the business has overall has been compromised. Also, if I give you a perfect example of significant fall in assets value, think about diesel cars. This is due to, remember that ULIS, especially in London and big cities, the diesel cars, the value of diesel cars have gone down because remember there is extra charge for it. So people prefer not to buy it. Another example can be, again, a new technology, which is in relation to that as well. So which is, think about electrical cars. Because the electrical cars are available, the other cars value have gone down or will go down as well. So therefore, that there is a strong indication. So the companies should check this, that it has not it has not impaired. It has not been impaired, in other words. So these are the external sources of information. Internal sources of indication of impairment could be that the asset became obsolete, you can't use it anymore, or there's a physical damage to the asset, or maybe that the performance of the asset has decreased significantly. So in other words, efficiency of the asset has decreased significantly. Yeah. So if there will be any internal indication or external indication of impairment, the company must check such assets for impairment in addition to those above. So those assets which have normally indefinite useful life, we check impairment on an annual basis. Okay, so how we calculate impairment is two steps approach in the impairment review. So first of all, you determine what's the carrying amount of the asset. In other words, carrying amount, net book value. Remember, also it is known as net book value. So what's that? And then what is the asset's recoverable amount? So which is higher of fair value less cost to sell or value in use. So once you determined, you know that the carrying amount minus recoverable amount will give you the impairment loss. But if the recoverable amount is greater than the carrying amount, in that case, there is no impairment happened. Okay, so I try to summarize these three international accounting standards, international financial reporting standards. If you will have any questions, you can always write your question in the comment section. I will be more than happy to answer those. Now, let's do a question which is kind of straightforward question, but this is for AAT level 4, drafting and interpreting financial statements. The good thing about this question is that you will understand how to apply the basic knowledge, what we talked about in these standards in a situation. Okay. So this is from AAT Practice Assessment 1, and it is task 4. Okay, in exam as well, as you know, you can open the reference material. So they have given you this information on a different sheet here. So what you can do is that you read about these matters and then answer these questions. Okay, so Buzz Limited is a manufacturer of electrical appliances. The finance director is preparing financial statement for the year ended 31st of December 2021 and has brought the following matters to your attention. So let's see the first one. A legal action was brought against Buzz Limited in November 2021, which is before the year end. Remember, year end is 31st of December 2021. You must notice that, because if it was after the year end, then it would have been events after the reporting date, which is a different accounting standard, IAS 10. Okay, so in November 2021, by a former employee who is claiming compensation of 50,000 for unfair dismissal, Buzz Limited solicitors have advised that there is 30% chance that the claim will be successful. Now, if you think about it, 30% chance, anything less than 50% is the possible. So it's not probable. If it is not probable, this is not a provision. We are not going to make a provision for that. So instead, this is a contingent liability, a future possible liability that will be confirmed by the court case decision, in other words. And remember what we do with the contingent liabilities. Again, 50,000 is material amount. And remember that contingent liability, if it is material, then we must show this as a notes to the financial statements. So if you look at the first question here, identify whether the legal action could be treated as a provision or a contingent liability. And we already established it is contingent liability. Please be mindful about the wordings. So you can see that 30% chance, anything less than 50%, you will be looking into that. They might use the word probable or possible as well. So you will make a note of that as well in order to decide, because you're just literally applying the knowledge you gained in the beginning of this video. Okay, state one reason for your answer. Now here you can write different answers. It could be more than one reason, but the key reason you can see here that as the case is a possibility, in other words, as losing the case is a possibility for company, which is the company name, which is Buzz Limited, and it is not probable. Therefore, it will be a contingent liability. So that's enough reason for 1 mark, okay? You can also say that there is no present obligation at the moment, okay? And remember that there has to be a present obligation in that case, or reliable estimate and all of that. You can mention as well. But the key thing here is that, of course, that it is possible that the company will lose the case, but it's not probable. Okay, so that's the answer to the first one. The second part of it, which is state the accounting treatment of matter 1 in Buzz Limited's financial statement for the year ended 31st of December 2021. So as we determine that this is a contingent liability, so you can write here that it is a contingent liability and material. You can, in brackets, you can write maybe 50,000 just to emphasize that. Therefore, Buzz Limited will show it in the notes in the notes to the financial statements. Again, for 1 mark, do not spend a lot of time. Concise and straightforward, as long as it covers everything, what is being asked. Now, matter 2, calculate the amount at which the machine should be recognized as a non-current asset in the treatment of financial position. So matter 2, you can see that is a lease liability, lease asset, in other words. On 1st of January 2021, Buzz Limited entered into a lease for a machine. The company was required to pay an initial deposit of 600, followed by 3 annual installments of 3,000 each, starting on 31st of December 2021. On 1st of January 2021, the present value of the 3 lease payments that fall due after this date is 8325. The machine has a useful life of 5 years. The rate of interest implicit in the lease is 4% per year. Ownership of the asset does not transfer to Buzz Limited at the end of the lease term. Now, remember, that doesn't really matter. As long as if it is not short-term lease, remember those are exceptions, and it's not low-value lease. Of course, it doesn't seem like low-value lease. So therefore, that we will be recording it as an asset and the full accounting treatment, remember? But in here, what they ask you the value of the machine, value of this asset as a non-current asset in the statement of financial position. So remember, the word we use is right to use asset. Okay. And remember, the way we write it is cost minus accumulated depreciation. So in this case, it will be accumulated depreciation will be just 1 year depreciation anyway. Okay. Now, what is cost? The key thing here you need to understand is that is present value of the future payments, okay, plus initial deposit. So the present value of the future payments, they're given to you 8325, yeah? Plus initial deposit, and initial deposit is given to you, which is 600. So that's the cost. Minus, remember, depreciation of the year will be considered as accumulated depreciation anyway. So if I put this in bracket and minus, so this depreciation we can decide now. The key thing you need to notice here that we calculate depreciation in relation to a lease asset shorter of lease term or the useful life. So if you think about in this question here, this matter here, you can see that the machine has a useful life of 5 years, and they are talking about how many lease payments followed by 3 annual installments, so which is 3 years. So which one is shorter? Of course, the lease term. So therefore, the way you will calculate this is whatever is the cost of the asset, which is 8325 plus 600. So in other words, 8925. So which is the cost. Remember, it is based on cost divided by useful life. So the useful life of the asset is 3, which is, sorry, not useful life, meaning that the shorter of the lease term or the useful life. So the shorter one is, of course, lease term here. So which will give us the accumulated depreciation or depreciation, because remember, this is the first year. So whatever amount that gives you, so this is how you need to show this kind of answer as well. Okay. So 8925 divided by 3, that gives you 2975. So 8925, that's cost, and minus depreciation, which is 2975. And that gives you 5950. Okay, so at this value, we will recognize this asset in our statement of financial position. So you can see for 2 marks, you must have to show the working. You cannot just write 5950 because they will only award you probably 1 mark, but not full 2 marks. So you must have to show the. And again, it's worth noticing the requirement, whether they're asking you to calculate or explain. If they would have said explain, I would have just explained this in wording. And you got to be careful that whether they're asking you for calculation or explanation. Because if they ask you for explanation and you are calculating it, you might lose some marks. You can use the numbers to explain, but you cannot then just calculate it. So you got to be careful with the requirements as well. Okay, explain your answer to 1. So whatever you calculated here, you will be explaining it in words now. So you will say that right to use asset is recognized in the statement of financial position as the cost after deducting, or you can write actually right to use an asset is recognized in the statement of financial position at net book value or carrying value. Okay. And then you can say that this is calculated as, and you can write that, which is cost minus accumulated depreciation. You're not going to use the numbers again because you already done that. Yeah. So that's 1. And then you can say as the depreciation is for the first year lease, as the depreciation for the first year lease, this will also be accumulated depreciation. And okay, and then you can further kind of explain, if you like, that the cost of the asset is present value of future lease payments plus initial deposit. Okay, and then depreciation, you can say depreciation is calculated by using lease term as this was lower than the useful life. If you think about it, we kind of explained everything there, what we done in here. And that's what they wanted. Again, if you'll be using the amounts again here, that will be just total waste of time. You're not going to get any mark for that. So you got to be careful there. Okay, so let's move on. Now, this is a separate issue. So this is not in relation to these 2 methods, by the way. Okay, now Trunk Limited provides gardening services. The company has entered into a 12-month contract for regular garden maintenance work commencing on 1st of July. The agreed contract price is 5,000 at 31st of December 2021. Trunk Limited estimates that it has completed 40% of the work required. Now, this is in relation to a separate or different accounting standard, which is IFRS 15, revenue recognition. So it's relatively a straightforward question. So what we actually record, in relation to the percentage of completion. So the total contract price you can see is 5,000 and 40% of 5,000, which gives you 2,000. So that will be the answer. So we can only recognize the revenue in relation to the part of the contract we completed. I will cover IFRS 15 on a different video, but for now, just remember that in relation to the percentage of the contract completed, we can only record that revenue. We can't record the rest of the 60%. We will record in future. Okay. Now, this last part of this question is about IAS 36, which is impairment of assets. And remember that impairment of asset is carrying amount minus recoverable amount. And remember the recoverable amount is the higher of fair value less cost to sell and value in use. So think about asset one, asset A. Fair value less cost to sell is 11,000, value in use is 14,000. So the recoverable amount is 14,000. And you can see the carrying amount is lower than the recoverable amount, so the asset has not been impaired. So asset A is not being impaired. Asset B. Now you can see the recoverable amount is 7,000, which is the higher of those two, value in use and fair value less cost to sell. And carrying amount is 9,000. Now you can see the carrying amount is higher than the recoverable amount, so therefore this asset has been impaired. Asset C. Recoverable amount is 15,000 and carrying amount is 10,000. So therefore it's not impaired. Okay, well, we completed this question and we covered those three international accounting standards. Hopefully that this video was useful. I will be making more videos on the international accounting standards, because this is one area the student normally tend to struggle in terms of the application of knowledge. So the key thing I will suggest is that make summary of each international accounting standard which can be tested, and try to remember those and apply those in your exam. Normally task 4 in drafting and interpreting financial statement, it comes up. If you're studying a different qualification, ACCA F3, F7, then just make sure that for F3, you must understand the summaries I am sharing with you. If you're a F7 student, just make sure that you study in detail, because any part of the accounting standard can be tested. Okay, well, thank you very much for listening. I will be back with other videos. Bye for now.